going, everyone? As part of our series of videos on helping you get into your new home, today we will cover some information on what affects your interest rate. So let's get started. When buying a home, everybody wants to know what the interest rate is and sometimes may be confused when your loan officer replies with, it depends. But this is actually a good response because the rate is affected by many different factors and is usually different for each borrower. This response shows that your loan officer may really want to educate you on the whole process instead of just giving you a number that may or may not be accurate. Now, the first thing that can affect your rate is external factors. Rates can be affected on a daily basis or even hourly basis by the markets, inflation, the lender, or sometimes even news cycles. So, even if you are given a rate today, if that rate is not locked in, it can fluctuate up or down at any time. In the description of this video, we have a link to the Freddie Mac interest rate survey. This is a daily survey of banks to get an average interest rate of recent loans. You can see that on this chart that it's obviously not flat, but that it actually fluctuates up and down on a daily basis. And while recently this rate has increased. So yes, the rate does depend on many factors for each borrower. The second and biggest, in my opinion, being the credit score. Depending on your credit score, your rate could be higher or lower. There are different levels within the credit score which could give you a better rate. So talk with us at the Tardif team about your score and how that affects your rate. If you are just a couple points away from the next level, there could be ways for you to improve your score quickly that would give you that better rate. Now, number 3, the loan to value ratio. This involves your down payment. Obviously, the more you put down, the better you look to a lender. So they may reward you with a better rate. The fourth thing that can affect your rate is the type of loan. There are 4 major loan programs, and we discussed those in another video. But they are conventional, FHA, VA, and USDA. Each of these programs have different requirements that may affect your interest rate. Now, loan term is another thing that can affect your rate. And this is really simply just how long you will be paying on the loan. 10, 15, 20, or 30 years. Lenders look at the loan term differently and usually offer different rates. Another thing is occupancy. Basically, will you be living in the house or not? Is it an investment property? Maybe you want to use it as an Airbnb, or is it your second or vacation home? Well, all of these will directly affect the interest rates quoted from the lender. Another thing is the type of property. Is it a house, a townhouse, a condo, a manufactured home? The type of property may affect your interest rate. For example, condos are usually higher than a single-family home. And at least for our list today, the last thing that we have is fixed versus adjustable. Now, a fixed rate means that the rate is the same for the entire life of the loan. An adjustable rate means that the rate may start out low, but then will adjust at a given time period toward a higher rate. While we haven't seen a lot of adjustable rate mortgages recently, there can sometimes be a big difference between these or fixed rate loans. So these are just some of the major ways that your rate could be affected. There could be others that are specific just to you, and this is a good reason to talk with us here at the Tardif team. To get a better idea of what your individual rate may be, and how we can help you get the best deal. So with all of that being said, don't forget to like and subscribe. Click that bell icon to stay up to date on everything that we upload here on the YouTube channel, as well as give us a follow on all of our socials like Facebook and Instagram. And that's gonna be it from me this week. Have a good one, everybody. I'm out.